Okay, so I'm just gonna start the recording now-ish. And all right, do you guys have any questions from last week? And like I said, if you guys want to speak, you guys can. Yeah, I can unmute you, Alan. But you just have to tell me in chat. I can't have the mics open. You understand the reason why, hopefully. Because if the mics were always open, people would just, they do stuff. They fidget around, so then that's a lot of feedback. So if you want us to talk, you just have to let me know, and I can do that. Okay. All right. So if there's no questions, there shouldn't really be any. Hopefully you guys just understand my philosophy towards the market as a whole. Okay, so we're going over that. Penny stocks. Have you guys also chosen a platform by now? As well. David says, still blown by the tick chart idea. Way better than time chart. Seriously, mind blowing. Can't believe it's not super popular. Okay. David, you can use NinjaTrader. I just don't support it because they're just, in my opinion, a shady company. So. Okay, cool. So, I kind of want to move this out of the way too. Do that. All right. So for some of you, this may be something you already know, but we're just going to go into the introduction of technical analysis, and then probably next week we're going to go into like indicators as a whole. So what is technical analysis? So technical analysis is a method of evaluating any kind of securities. Securities in our case is inclusive of not just stocks, but stocks, bonds, and futures market options, anything that has to do with trading, by analyzing statistics generated by market activity, such as past prices and volume. Technical analysts do not attempt to measure a security's intrinsic value, meaning when we're doing technical analysis in any form, we're not trying to guess like what something is worth. We're just essentially, technical analysis is the art of finding patterns. Okay. And the reason it really works, okay, you need to understand something, and I'm just going to say this right off the bat, that technical analysis, like, the market doesn't know it should have patterns. Okay. Does that make sense to everyone? Meaning it is unbiased. Who brings the bias to the table? You do. Okay. So it doesn't know that it has any of these patterns that we talk about. Is just because, remember, human beings can only describe things in relationship to each other. Okay? That's why all language is garbage. Okay? Because you can't ever get to the thing. You can only describe the relationship of something because something else exists. Okay? That's it. If there was no yin and yang of it, then you would never be able to actually explain anything. Okay? So it works, technical analysis works because people expect it to work. And the market is not a complex machine, and often it follows patterns. Okay? And you could also make the argument it follows patterns because obviously people are involved, and people generally do the same thing over and over and over and over again. Okay? So that's really why technical analysis works. There's no magic to it. Okay? There's no mystique to it. I don't want you to ever walk away from me or learn something from me or anyone else and think that there's some kind of magic to it, because there's not. Okay? So I'm a trader and a person, if you guys haven't figured this out, that kind of believes that most of life is a middle path, and or the market is a middle path, and therefore there's this thing called equilibrium that exists. So what is equilibrium? Is basically a state in which opposing forces or influences are balanced. And how this relates to trading is, I'm a trader who does not believe in bear or bull markets. I believe only in equilibrium. You see, there's always seems to be these two opposing forces in the market, bear or bull. However, if you look at the stock market from a long-term perspective, what is the only thing the market has done? You guys can type that into the answer box. Okay, yeah, the long run historical ideology of the market is it's gone up. Okay, so if that's all the market has ever done, then where is this bear market that everyone speaks of? Where is it? Okay, so again, bear and bull markets are they coexist. Okay, there is it's just a way to describe something that's happening. Okay, but from my point of view, at least, like, there are opposing forces. So like, people just focus on the stock market, that's fine. But you can have a bear market in oil while the stock market is in a bull market kind of phase. Okay? And that's what's actually supposed to happen. So it's just a way to describe a market condition, but in my opinion, it kind of doesn't exist. Okay? So there's only equilibrium. That's it. Meaning the market is going to trade as a whole. It tries to find balance, just like humans do, and we only make money when we're out of balance. That's really what it comes down to. So any kind of volatility, any way you want to describe it, is really just the market moving from one balance area, going chaotic, and then trying to find balance at another area. And the reason I kind of point this out, even though it may seem obvious, is because when you tend to use language that's like it's a bear market or it's a bull market, you start to ignore, you automatically subconsciously ignore everything that's going on. Okay? And when you do that, what's the danger of doing that? You're missing the other side. Like, you're unable to think about what could happen, or you're unable to make something or create something because you're only focusing on one area. Okay? So this is not necessarily a unique idea, but this is an idea that's never talked about ever. Okay? Except unless you're used to me. Okay? So now we're just going to get into the normal jargon so we're all on the same page. So you'll probably hear about support and resistance. What is support? What is resistance? So it's common jargon for areas on the chart where price has a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like a price ceiling that price cannot break above. Knowing these levels are make it much easier to decide when to open and close trades, but how can we locate these prices to begin with? So because technical analysis is somewhat of an art form, there are no like absolutes, but objectively, anytime we draw anything on a chart, we want to see like multiple points of contact on the chart to say that's support or resistance. Okay. And what I tend to like to do is if I draw a support level going, let's just say in this case, straight along a certain area. Okay. Then I'm just going to, generally most platforms have this where you can like do what's known as parallel, meaning you just copy this line and then I move it and I just find multiple points of where resistance could be. Now, most people, even myself, we're looking for basically the highest high of some kind of given range that we see and the lowest low. And this kind of like, this would be what's known as a sideways market. Okay. See how the market's just doing nothing. It's just bouncing. So now one thing you want to keep in mind though is that you can't draw any of this, okay, without seeing this first, okay? So what does that mean? That means that, I mean, you don't have to wait for this. You could cut it off like right here, okay? You could say 1, 2, 3. Okay, so now you've got this kind of like, you know, this is confirmed by this, and then the only part is like we just have this one upper area. But let's say that's all we saw. Now only at these 2 points can we say we should be possible seller here's or possible buyers here. Okay. And the reason that is because we've just drawn basically support, which has 2 touches, and resistance, which has 1. Okay. But don't let anyone fool you into doing that hindsight bullshit that people do, which is like, oh, you see it formed this huge pattern, we saw it before. No, they didn't, because if you're really honest with yourself, if you're drawing support and resistance, you're not going to see any of this. And so at some level you have to have some faith here, and you have to say this is the resistance line, and this is really neatly drawn. Okay, I would never draw anything to, remember how we talked about candlesticks, to the wick like this. I would draw it always to the body. Okay, and the reason I would do that is because the market is not, the market does not respect support and resistance. Okay, and what I mean by that is that it sometimes will go below and sometimes it will pop out. Okay, and oftentimes, and I'm just gonna redraw this. Okay, and oftentimes, this is the reality of the situation. So, the market comes up, it starts a trend somewhere, okay? It looks well behaved, all right? But then it does something like this, okay? Everyone is losing their shit because they're like, oh, I bought here, what's going to happen? You don't buy there. You just don't, you don't do it, okay? You let the market come down, retrace. This is what I call one test up, or one test down, right back up. And then we wait for a close above this area. And if it's a green bar or green candlestick bar, you could look to buy. And your first target is always going to be the midline. And your second target is always going to be the top of the range. Okay, if in a selling situation, what happens? It blasts through the area. People are like, why didn't the market stop here? Shut your mouth. Okay, don't complain. Because what you're doing is essentially voodoo. All right. Markets don't respect these areas. They tend to move through them, and then you need to wait for it to move back and prove to you that it's going to actually respect that level. If it starts to fail, look to sell back down. You can generally buy or sell what's known as a range bound market. And in this example, this is resistance at the top and this is support at the bottom. Okay. Now I want everyone to write this into chat so we all understand. I want you to say, this is voodoo. I understand that this is voodoo. It's magic. Okay. I shouldn't really pick out a particular religion, but just say it's magic. Okay. It's magic. Okay. All right. So you may ask yourself, well, why are we learning this? Because you need to know it. Okay. You need to know it. But in the same token, you don't want to live, breathe, and die by it. All right. So, and I'm always going to preference it like that. All right. Let's go on to the next thing. Okay. Another thing you may look at is, or hear about, is something called psychological levels. Okay. So psychological levels are often called psych levels and occur when price ends with multiples of 0. Now, this is a man-made artifact, but I want you to understand the terminology, because when you hear it, I want you to be like, I know what that is. It's human nature to gravitate generally towards round numbers. It just is. And people will make some kind of assumption and say, Matt, the market's changed, blah, 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 blah. That's BS. Okay, it hasn't changed one bit. Just because machines are involved, who makes those machines? Humans do. Therefore, unless machines build machines, kind of like in a Terminator situation, there's always going to be imperfections in any kind of coding, and there's always going to be biases. Okay, so if you notice on this chart, and this is just a random stock that I selected, what you'll see is 829. Okay, 1731. Those seem completely random, but here we have 1956. Okay, 1975, 1729. So you see, like, there's like, it seems to be through history of this particular stock that it moves. It likes to stay around quarters and whole numbers. So here's a quarter, here's a quarter, here's a 50, right? Here's a quarter. Here's a quarter, there's 50, there's a whole digit number, quarter. So it's kind of interesting. Like, it's not exact, but it's interesting to just note, like, I mean, the market is random to a point, right? Like, that's what the idea behind psychological levels are, and that's all you need to know about it. That's what a psychological level is. So if you put your stop loss, though, something to keep in mind is like, remember what we talked about stop losses, is you don't want to necessarily place a stop loss at a psychological level. Meaning, if you hear someone say that, what they're referring to is like, you know, if you're trading at 1950, we'll just call it 1950, and you sell short, your stop loss shouldn't be at 1950, right? It should probably be at like some kind of weird number, maybe at like, so you sell short at, let's say you sell short at 1950, you sell short at 1950, the market keeps going, you put your stop loss, you know, let's say 73 cents. So not at an exact number. You don't ever kind of want to do an exact number. In the futures market, you have to do kind of an exact number. Still, you kind of want to stay away from like half and whole marks. Okay. This one, quarter marks, sometimes you can't escape that. You're just really worried about the dollar value, not necessarily. It's kind of a little bit different in futures, but this is what people mean with psychological levels. Okay. All right. Swing high and swing low. So swing high and swing low is another great way that you can find support and resistance. Okay. And basically you mark the levels in the past where price had a difficult time breaking through. As price moves up and down, each level that price has bounced off of could be a level in the future that price bounces off of again. This can be a manually intensive method. Okay, so if we go back here, and I kind of want, like, why can't I grab my ink tool. Thank you. Okay. And is it going to disappear on me? No. Excellent. Okay. So if we look at this now, let's say we see this market, it's coming down, it's coming down, it's coming down, it's coming down. Now this is a 240-minute chart, which means it's about a 4-hour chart. So each candle is 4 hours. So what we're going to see is like the market's coming down like so, and then it bounces. Okay. So what most people would do in this case is they're not going to see any of this information. This is going to be the low. Okay. And this is going to be the high of a range. So we've just established a range like we just did before. Okay. Now what happens? Well, the market comes down. If this is true support, people should be looking to buy. Okay. What happens? Are we going to just buy here blindly? No. Okay. We have one test. That's fine. We have two tests. That's fine. On the third test, guess what? It comes down below. Down below. Okay. I want to see this where it moves out and it comes right back up. And if the bar had closed above here like so, green, then I would be willing to buy this bar with a stop loss under here. Okay. And my first target would be here and my second target would be there. Okay. Very simple. Easy. Okay. But this is what I call one test out, right back up. And you see it failed to do that. So on that failure, now I could look to sell. What do I mean by failure? On that candle that should have been green, it was red. So guess what? On the open of this next bar, I could look to sell and my stop loss is going to be up here. Okay. And then what's going to happen is it's going to move down in my favor in this case, but I could have been stopped out as well. It's not a perfect science. All right. But within this now, if you guys come back here, you see what's happening. It's a bouncing ball. And this is actually how markets move. Okay. And there's a whole methodology called, oh my God, what's it called? I can't believe I'm drawing a blank here. There's a whole methodology that uses swing highs and swing lows to try to predict movements. And it's total BS. Okay. But essentially what they're trying to do is predict when it will sell and when it will sell down and when it will bounce up. And, God, I can't believe I can't remember the name, but it's very popular still to this day. And it's total BS. It's not specific. It's not rules based. And it's like trying to predict swing high and swing lows, and it does a terrible job at it. Okay. So the point is that, you know, when someone says this, all they're talking about is this is an established high and this is an established low of that preceding range. But this would also be a high. And let's just say this chart stopped there. That would also be a high. Okay. So, oh my God, this is going to fucking drive me insane. Stop doing that. Like, honestly, it's really not that complicated, computer. Like, stop. Like, I don't understand. There's no reason for you to exit. So, channel trading is another Elliott wave. Thank you. Okay. So Elliott wave is not specific enough to use in trading. So therefore, because it's not specific enough and it requires some kind of magic to go along with it, it's completely useless. Okay. And there are tons of people that fall for that kind of methodology because they're like, ooh, swing high, swing lows. You can program swing high, swing lows, but you have to know what you're doing and you have to understand market structure, and it has to be specific. Okay. So people who use Elliott wave theory and think that they can make money off of it are generally mistaken, but it's a very widely used thing from the 80s, and it blows my mind. But the point is like, it uses swing high, swing lows. Someone Albert just said ABCD pattern. That's another name for Elliott wave. Okay. It's still all nonsense and garbage. Okay. It's not specific enough. It's actually, in my opinion, even worse than drawing channels or drawing support and resistance levels, because it's so non-specific. It's just the illusion of being specific, which I always think is funny. So another thing is channel trading. All right. So channel trading is basically, in the context of technical analysis, is a channel is defined as an area between two parallel trend lines and is often taken as a measure of a trading range. The upper trend line connects the price peaks or the highs, like you see in this graph down here, or the closes, and the lower trend line connects lows or closes. An example of a channel is shown below. Breakout points in a channel indicate bullish on upward trends or bearish on downward trends. Okay? So, is this a channel? Fibs are also garbage because they're not specific. You can use them in a program, of course, and make them specific, but again, you have to be objective. You know, we're going to talk about that, but I just want you to get the basic concept down. Okay? So what I drew over here, is this a channel? Trading Bell says yes. Norman says yes. Albert says yes. Great. Good. What I call this is just a sideways market or a trading range. Okay? Is this a channel? Yes. So what does this kind of channel indicate? Because it's tilted up, it's bullish, right? And is this a channel coming down? Yes. Okay. So there's only three things that can happen in the market. I want you guys to really understand this. There's only three things. A market can go sideways, it can go up, or it can go down. That's the only thing that can happen. Okay? 3 possibilities with an infinite number of combinations. That's what makes it frustrating. All right? So all of these are channels, and all of them indicate something. This is bullish, this is bearish because it's going down, and this is sideways. All right? So that's basically the essence of a channel. Okay, and then so this is from Apple. Okay, so one thing I want to teach you about the way that I trade channels, at least if I was ever going to do such a thing, okay, is you see how Apple created a range. Okay, so it created a range. We all can agree to that. With what I call a bullish bias. Why is that bullish? Because the trend, just from pure price action alone, is what? It's up. Okay? So this is a range-bound market with a bullish bias to it. What does that mean for me? In a range-bound market, the rule is, can I sell this? Of course I can in a range-bound market, but I need to be cautious because the tail is bullish. The easier side of the trade is always going to be, in this specific case, to buy here, okay, around this area. Now, what do I want to look for? I want to look for a day that looks like this. So one test out, right back up, and when it closes, I want to look for buying opportunities, and my stop loss is going to be below the low of that one test out. Does that make sense to everyone? Do you see how very specific that is? Okay, this is not you making any decision. It is completely mechanical. First test out. Are we buying this into a panic? No. What are we waiting for? We're waiting for this bar right there. You see how it closes above? Okay, so we could do like an end of day close, or because this bar down here, and I'm just going to erase everything so we can see it clear. This bar down here, you see how the close, now remember a bar's close, these are normal OHLC bars. This is the close over here, and this is the open. Left guy says I'm open, right guy says I'm closed. So there was no close. Only on this bar was there a close. And by the end of the day, around like 3:45, you would know where it's approximately going to close. So you could say, I'm just going to enter in here, and I don't even know what that price was. Let's just call it like, we'll call it 90 something. This is 96 down here, so maybe 97. So we'll call this like 97. We buy at 97 with a stop loss below 94. That's a $3 risk. Okay, what's our first target going to be? Up here. Our second target is going to be anything that happens to it thereafter. And we would anticipate this breakout because of the bullish bias. Okay? Now, if, and this is very important, and I'm using a trading range because I think it's the easiest to understand, and this is going to play into everything I do thereafter and teach you guys. But because of this bullish bias, what happens though if this happens? Okay, so we have a bullish range bound market like this, bullish bias. Now, if I want to short this, I can do that in a range bound market, and my first target's always going to be the base. Okay, but if I wanted to short this, for me at least, what I could do is if it comes back up and it starts to fail, I'm going to sell short, and I'm going to just take the midline of this range, and that's going to be my stop loss. Okay, and when I do that, I'm just going to wait for failure, and then I'm going to sell short on the next bar. And what's price going to do? It's going to come back all the way, generally speaking, to what's known as the scene of the crime, or something I call the SOC. Okay, a lot of people have started using that terminology and totally plagiarized. But the point is that the SOC, if this bias doesn't work out, the secondary hypothesis, so if the buying pressure doesn't work on this one test out right back up, if it doesn't work, we can look to go short. Our stop loss is here. And legitimately, if it starts to fail, we should anticipate the fact it will come all the way back to 92. And that doesn't mean it's going to break through 92, but with some degree of confidence, we can say that if the range fails, okay, so let's say this didn't happen where it didn't close above, okay, and so this is one test out. One test out usually looks like a V, okay, and then we're waiting basically for the next 1 to 2 candles to see what happens, okay? But we don't really have to worry about it. If we're not comfortable shorting down here, which most people aren't anyways, then you don't even have to worry about it. You're just looking for a close above, which is pretty clear usually. Okay, it doesn't mean it's always going to work, but legitimately it gives you a structure to say, if this doesn't work, this is what we're looking for, a very specific thing. But if it doesn't do, we have a secondary expectation. Okay, and I usually in my watch list call this the primary and the secondary hypothesis. Okay, so that's the way I look at it. Is this where you bought the calls? Yeah, this is where I bought call options, and I got out like here, and I didn't, because I didn't anticipate it would just go shoom, but it did. Okay. The trading range is established when it looks like it's going sideways like this. So you see how it comes up and it comes doom, doom, and it starts bouncing around. At this point, I would establish a trading range, okay, because it's got 2 on the top, 2 on the bottom, okay. So that's how I do it. So the only pieces of information I know are literally over on this side, or on this side. I establish the range, and then I'm just patient. Okay? Damn it. So when you're talking about close, you're speaking at the end of day close. That's correct, Marcus. David says, and what would be considered a channel? So we go from a range bound market with a bullish bias, right? So we're looking to buy and we're anticipating that it breaks out of that range. Okay. We're going to take some off the table because we don't want to be greedy. We want to take some off the midline, take some off at the high, and then the third target is really this kind of like runner. Okay. You don't have to do it that way. I just, because it's a floozy kind of, since technical analysis is pretty much not concrete, even with the structures that I'm giving it, in my opinion, like, we just want to make sure we're taking some off the table. Okay. You don't have to do that, but it's a good idea. So the channel itself is from this low, okay, all the way up. Okay, now how do we establish that? Well, we don't know this channel until right about, and this is a daily chart, right about here. Okay, so what we're going to say is we're just going to connect the bottom, right? And I could have drawn this down more like that, okay? I know that was shittily drawn by me, but overall, I could have done that. I just kept it like this. So now we have a channel, a range, right? And, I actually drew this purple line wrong. We could have started to establish it like right here, which we would, because it's just like it's bouncing, it comes back up, it failed. Fine, that's okay. We're still going to establish a channel and say there's something going on here. So again, we have this one test out. We had to close above. On the next bars open, we'll be buyers. And what we're going to look to do is we're going to look for this as the first target. Bam, that did happen. And this is going to be the second target. And that's going to be projected by the fact of we're saying that this is a channel. Okay. But remember, we're imposing a construct on the market. So we don't want to be greedy and buy here and be like, it's going all the way up here. It could. Okay. It could. But we just want to take some off the table. All right. And so we had a range bound market in this case, which we anticipate, which is why we're looking to be a buyer at here, and we're looking for a breakout. Okay. So it went from a range bound market into a breakout, which was this enormous push. Okay. So push up, then it comes back down and it starts bouncing around. Now we can establish some kind of channel, because this channel line, even though I didn't draw it, is kind of connected to all of these things. Okay. You see how it kind of goes from here to here. Okay. All the way through. All right. And these are like little peaks. All right. So there's that as well. So, are there any questions on this? So a channel is basically an area of stabilization. No, it's just connecting price between areas. Okay. You don't want to see this as absolutes. Okay. Get that out of your mind. You're seeing a pattern, essentially. You're applying a pattern to this market, and then you are trading off of the pattern you see. But it doesn't mean that it's necessarily real. Okay. So that's why we have to use risk, and we have to have targets. The number one reason why people generally suck at technical analysis is because there's no construction to what they're doing. Okay, this is very specific in what I'm looking for. So range bound market, bullish bias, into a breakout, which we anticipated. Okay, we didn't know how far it would go. We don't know anything like that. Okay, you can try to project that out, but it's not, I mean, there's tons of ways you can do it, but it's not, I don't like to do that. you could say, okay, whatever the range is between 102 and 94, divide that by 2. And then you could say, well, if I'm going to project a range, then, that's 4. So I'm looking for 4 points above the breakout, which would get you about like right here, which is where I ended up taking money anyways. Okay. Marcus says, just to be sure, because you just blew my mind in a positive way, you're recording your screen right now. Yeah, I did. I'm recording. Okay. So we want to make sure that, so remember that any kind of support, resistance, or pattern we come up with, we're always going to look to the tail to tell us which direction we should be trading in. And remember, we're not using any technical indicators yet. So we're just going to say that's like a rule of thumb. All right. So then when we have that kind of going on, then we have an expectation of the market. Okay. So that is like half the battle. Most traders who come to the market every single day, little day traders, have zero expectation of the market, and therefore that is why most of them lose right off the bat. Okay? So this is a very formulated way of technical analysis because it's a range-bound market with a bullish bias. So we're looking to buy. We're looking for it to break out to the downside. It may not, though. Okay? But I like those kinds of patterns if it never happens because I want to see how serious essentially these people are. So it breaks out to the bottom and it tests out once. It comes back. It closes above. That's strength. So then we would look for the midline and then we would look for the top of the range. Okay. So then we have a breakout, which we can calculate if you want to. Like I said, you could take the entire range from the high to the low, divide by 2, and you could get a price target, if you will. All right. And then on top of that, okay, you could just let it keep running. But the thing is like when it breaks out into new territory or breaks low into new territory, right? You don't really know. So you want to you don't want to be fucking greedy, but you're using measured risk. Do you see how that's different than the way that most people are taught, which is the low of you buying this kind of like range bound market like this? Okay. So it breaks out like this and it closes above like that. Okay. This is your stop loss. If you can't withstand that, okay, then don't buy that because that is what we call volatility down here. It's showing you volatility, and in some ways you can't escape that. So if you're not willing to let the market move against you by 4 points in this case, or $4, okay, then don't take the trade. Don't try to micromanage it. Okay, just let it do its thing. Your first target's here, which it like completely crushed. So your first target really is somewhere in here. Your second target, like I said, you would take the high of this range, which in this case is 102, and the low of this range, which is like, we'll call it 95. So we'll call this 102 and this 95 just for real quick. Okay, that's 7, 3.5, we'll call it 4. Your extension target, you've already taken some off the table. Your extension target is going to be here, which is where I completely got out of everything. And then this is the great unknown, okay? So really, because that becomes something where it's like 2 or 3x from where you bought. And if you're not taking money off the table or getting out of your position completely at that point, you should really look at yourself in the mirror and say, what the fuck am I doing? Okay. Because if you're making, 100, 200% on something, not options, but this is a freaking insane move. Okay. You could look at it in a percentile. This is like, let's say 10, is that right? 10. It's like 10, 15. We'll call it like 15%. Okay. This is a 15% move from where your entry is. If you're not taking money off of that, you're crazy. You're fucking crazy, and you don't deserve to be trading, and you deserve to lose all of your money, in my opinion. Okay. So measured stop loss off of a range. Okay. Breakout. We know which way we should be trading by what? The direction. Okay. And we could calculate the measured move out of the breakout. We just don't want to be too greedy. Okay. You see how, let's say you were actually put yourself in the mindset of this trade. Okay. If you didn't know what you were doing, you're like, this shit is going to the moon and I'm just going to keep loading and loading and loading. Okay. So that's how that we have our risk. We have a reward 1, we have a reward 2, and reward 3 is just like the great unknown. Okay. So now we break out and we establish a channel down here. Okay. So we know our channel basically on this date. Do we know a channel anytime before that? No. We're not going to bullshit ourselves when we're looking at something historically and say, oh yeah, I see that. Right? We just know this up to this point. So now what are we looking for? We're looking for a test out, right back up. It closes above. We're buying. If we want to be a buyer here, we're buying on the next bar open. We're going to get out somewhere in here. Why? Because that is the range, right? That's the midline of the range that we have. And then our target can be somewhere up here. Period. End of story. Okay. Does this make sense to everyone? I just want to make sure we're absolutely 100% crystal clear. Okay. And this is probably a little bit different than the way you read technical analysis in little books, which is why books are useless. Okay. This is old school charting with a twist of try on top of it. Okay. It's like a drink special. All right. So that is a channel in a range bound market. So we talked about those two things. We saw those two things and we explained those two things. So it should be good. All right. Another thing I want to talk about is traps. Okay. Now traps, if you ever hear this word, are essentially what we just talked about. If you hear someone say bear trap, this is what they mean. Okay. Or a bull trap. This is no different than having a range bound market like this. Okay. Range bound market, bearish bias. Okay. Now, why do people call these traps? They call them traps because they think it's a trap because they don't pay attention to the already obvious it's bearish. The market's moving down. The candle's coming down into the trap is bearish. Why is that bearish? Because this tells us, hey, if we go into a range bound market like this, it's a bear trap because people are going to be trying to buy once they see a range is established. We want to look to sell because that is the natural trend of this. Can that be reversed? Yes. And in this case, it did break out. It did move back up and it broke out again. So you could have made, you would be targeting this. Okay. But it didn't make it all that way. And guess what? You would have probably been stopped out. Too bad. That shit happens. That's the reality of trading. Okay. Bull trap is the same thing we just talked about, which is what is the bias down here? It's bullish. What does it do? It's going sideways. Okay. Now these charts that you see right here and right here are on small time frames. And I did that because I want you to see, like, these are tick charts essentially. I want you to see that it doesn't matter. The shit repeats itself. Okay. So whether you're doing it on a long-term chart or you're doing it on a short-term chart, okay, it's the same, it's the same, it's the same, it's the same process. It doesn't matter. Okay. But people call them different names. It's like, remember, English doesn't have really any kind of different, everything is pretty, in the United States at least, English only has essentially one dialect, which is what we all speak. And, but we call shit by different names only to confuse people. Okay. A bear trap to me is nothing new. Okay. Someone just came up with a name and was like, it's the bear trap. And because they wanted to feel special about themselves. Okay. But if my students hear something, I want them to know like what the terminology is. And so that way they could just be like, oh, it's just this. It's nothing special. Okay. Classic chart patterns that I pay attention to. These aren't all the chart patterns. If you want like an in-depth classical chart pattern, that's all you want to learn, I'm not the dude for that. There's tons of different patterns out there. But these are the ones that I pay attention to the most. Okay. And the reason I do that is because statistically speaking, they generally work 57% of the time. Okay. So they're not high odds, but they're generally pretty freaking consistent. Okay. So what are they? Double bottoms, double tops, cup and handles. Now, cup and handle is one, and I will preface this, cup and handle is one that I don't really like. Okay. It's probably the worst one, and it's hard to find, and it doesn't happen that often. So pattern recognition from the mind's eye is difficult because you don't have a lot of examples, and they're really generally sloppy. Okay. Which is fine, because sloppiness is next to godliness in this case. Okay. Because I don't really ever want to see a textbook chart, a textbook pattern. Okay. Because that's not the real world. Sometimes it happens and it's a miracle, but most of the time these patterns look like something. They're not precise. Okay. Ascending triangle, descending triangle, bull flag, bear flag, and then I'm going to teach you my own patterns that I personally have come up with. What does that mean? That means if someone else says it, uses it, talks about it, it's not theirs. Okay? It's mine. All right? And people have stolen this shit from me. It's already gone out in the sphere of things. Okay? So, and the reason I have patterns I've come up with myself is because there is no rules to chart patterns. You can, it's an art. Okay. So let's go over them. And a lot of these you have seen before. And then we're going to go look at actual charts. And then we're actually going to look at some of the shit that's happened in real time. Okay. Because this is all just for the premise or the context of just learning. Okay. What is a double bottom? It sounds just like it is. Very few things are like that in the world, I think. All right. Literally meaning the market has a reversal. It's bullish. Typically found on any kind of chart, bar charts, line charts, candlestick charts. And as its name implies, this pattern is made up of two consecutive troughs. Okay. Through that are roughly equal. Okay. Now, if you're looking at this, your mind will already see something that we just talked about. So if you look at this chart, well, what does it look like as it's, so ignore this blue line, but focus in on these red lines. What do you see? What's happening as it's going across? What pattern is that going across? I only got one answer. Focus on this red. What's happening? We just talked about it. Correct. It's a sideways market. Okay. Sideways channel. Okay. Perfectly acceptable answers. All right. And what was going into this market? What kind of shape was going into the sideways channel? You could call it a bear trap if you want, Alan, but again, remember, it's not a term I use. I just want you to be aware that it's the same thing. Okay, so it's bearish. So what does that mean for us? So ignore the fact that it broke out. What does that mean for us? What would we be looking to do if price comes back up? We'd be looking to short. Okay. Now, here's the deal. What happens? Okay. So this is why you don't have to be perfect. Okay. So you see how we have an established range with a bearish bias, right? Okay. So we know that based off of this, This is the range, right? Up until this point, we wouldn't know a damn thing. Not one thing. Okay? We have 1 point here and 2 points technically there. Okay? So we could say, it's starting to look like a range and the market has come down, right? So what do we do? Like I said, you can always buy a range and your stop loss is going to be the lowest low. So in this case, that'd be dangerous because it's bearish, but you can do that in range bound markets. But your stop loss would be this low. Okay? Now, if we're going to be purely technical about it, we're looking to sell. Where are we going to look to sell? We can sell either if it breaks below and comes out and starts to fail. That's one. Or we can look to sell up here. Now, why wouldn't we sell up here? Why wouldn't we do that? And I'm just going to clean it up so you can see. And maybe you can't see because I do realize that it is small. But what happens at that line? Right? It wasn't tested. And when it was, what happened? Right. It closed above. Okay. It closed above this area, which means it's a no-go. If you're sitting here for months, November, December, January, February, you're licking your chops. You're like, yes, finally, come to Big Daddy. Let me short you. Okay? But guess what happens? It does something completely unexpected. Well, it shouldn't be, but it closes above. So until it closes below this line, it's bullish now. Okay? Because it's proven itself that, hey, I don't want to be down here anymore. Now, double bottoms usually, okay, and this is a pretty terrible example, but it's just one I found online, look like this. Okay? Like that. Now, what everyone tries to do when they see a double bottom is they want to be buying here. Okay? But confirmation of a double bottom doesn't happen until it breaks out. So you have to be willing to buy up here. Okay? Is this uncomfortable as hell? Yes, it really is. Because what's your real risk? Your risk will just be the midline in this case. Okay? Which isn't too bad, but it's generally, that doesn't sit well with people. But oftentimes, you'll never see a double bottom coming. It's generally hard to see. I mean, like, I usually see them forming usually right about here. Okay? So there's really no place for me to buy. And what I'm going to look for is I'm going to look for, okay, are you testing or are you breaking? And if you're breaking on a pullback, okay, which this only had like 2 days essentially of a pullback, this is where I want to be a buyer. This is my stop loss. Because double bottoms, when they happen and they break out, okay, are very powerful. It happened in the S&P and nobody saw it except me and my watch list subs. Okay.